Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, good morning, good afternoon, and welcome to Develop Your Edge with Anthony Crudele. I'll be your co-host, Tom Schneider, CMT with NinjaTrader. And today it is my pleasure to welcome back Anthony Crudele to the show. It's been a while, Anthony. How you doing?
I'm doing great, man. It's great to be back. Busy times. Going to be a fun day doing a live micro trading session, so I'm excited.
Yeah, me too. I think this is the first time we've actually made this the focus of our show. But you've been gone for a while. We've been showing the best of Anthony. How you've been?
Yeah, I've been great. I wanted to kick off coming back with this show because I wanted to really put some things together. We talk a lot about different edges on Develop Your Edge. And in this show, I wanted to just tie some things together. I want to talk about who should be trading micros, why you should be trading micros, what I think is the simplest strategy to trade micros. We're going to focus on the micro E-mini S&P today because I think a lot of people look at the micro E-mini S&P as kind of that initial product, especially because the E-mini S&P is so popular that the micro E-mini S&P is really probably that first step that a new futures trader would take. And so we're going to cover all of that today.
Yeah, this is great. I can't wait to see, basically Anthony trading in action. Like you said, we've looked at different edges and you've focused on different pieces. And in fact, that's what we showed a lot when you were gone, is the best of Anthony was about some of those pieces. But it'll be really interesting to see how you're looking at everything in action and that next step, which is actually placing an order. So I'm excited. I really am. This is great stuff.
So let's start off with what a micro is. I think most people that are watching the show know what a micro is. And we're going to talk about the micro E-mini S&P. And that's going to be 1/10 the size of the regular S&P. So the regular S&P is $12.50 a tick. This is $1.25 a tick. So you're going to have obviously a much less expensive product. And in this volatility, I think this is really great for new traders. I think it's also great for traders that are more advanced like myself. I personally don't trade the micro E-mini S&P. What I do with the micro E-mini S&P is I use it a lot to test strategies to come in and to get some reps. Even sometimes when I'm a little foggy or I'm not trading very well, I'll come in and I'll trade the micro just to keep my rhythm. And so I think that when we look at the micro is obviously for those with a lower either risk tolerance or for those that don't have the funds to take on the bigger S&P. It really is geared towards that. And I say that because as you grow as a trader, if you're taking on more risk, if you're trading more than 10 micros, I think you should be going to the full contract because you want to be able to capitalize on trading the bigger product with less amount of contracts. So you have that cost that goes into that. And so I think that when you're trading micros, if you're trading them more than 10, you probably want to start trying to find your way into the big E-mini S&P. And I think that's an important point because, like I said, you don't want to be over trading in the micros. It's a great stepping stone to the E-mini. And I also think one thing I didn't mention is it also can be a hedge to an E-mini. And so if you have one full E-mini on, you could actually scale out with the micro and then just, swap that contract out at the end, I think that it's important to recognize that because I think one of the most common mistakes that people will have when you have a product that is less expensive is the over trading aspect of it. And if it's not where you're getting in and you feel that it's too small, then you should be looking to get to a bigger product. And so that's really the first thing I want to say, because over trading is a killer. And so that I wanted to just kind of get that out there first, Tom.
And when you say over trading, can you just go into a little bit about, your experience when you started, maybe the over trading, how frequent it was? Why is that a killer? Is it because of the fees mainly that you have to pay for each trade, that kind of thing?
Well, fees definitely matter. There's no doubt. And that's why I said initially that if you're trading more, you should obviously go to the E-mini, the bigger product. For fees is one aspect of it, but it's not the entire aspect of it. It's building the bad habits of over trading, right? And so for me, when you get into a micro situation, if you're always working your way to 10 or greater and you're just clicking a lot, then what's happening is, I think you're not truly scaling the right way. And what I mean by that is that you're probably too active and too loose with the position. So if you're click to get in with 10, you're not, it's that area is probably too, it doesn't matter as much to you. And when you have a little bit more money on the line, I actually think that's a good thing in a lot of ways. And the reason why I say that is because then you get pickier about what you're going to do. And where I think over trading kills people is that it seems as though, oh, well, it's only $1.25 a tick in the E-mini S&P. I'll just keep clicking in and averaging in, and you end up averaging in into a really bad position, right? And you're adding to losers quite often, more often, because it's only a micro. And so that's why I think that actual dollar amount of getting into a bigger product is really important if you can afford to get there. And the micro should just be a product that you use if you don't have the funds to do it, if you can't afford to trade at the bigger product, or obviously you're new, or like I said, also testing strategies. And I just think that's important. Don't abuse the product is more of kind of where I'm getting at with this.
Gotcha. No, that makes sense. That makes complete sense.
So now that we've got that out of the way, I want to go into a strategy that I think is the best for trading the micros. And the reason why I say this is because I'm going to take this from the very beginner perspective. And the reason I want to do that with this is because a lot of people that are going to be coming into micros or coming into futures, you're new. And you're going to look at the marketing. You're going to say, look, there's all these different strategies. There's all these different things that Anthony's talked about on Develop Your Edge. What is a very basic strategy I could come in and trade micros? I also want to hold a rule today that when I go in and I start looking at some possible trades, that I'm only going to use 3. And the reason why I'm only going to use 3 is because when I think of scaling, for me, everything is a third. I do this with my big E-mini S&Ps and pretty much every product that I'm in. Anytime that I'm day trading, I always look at it into thirds. And the reason why I do that is because I want to be able to get into a position as the market's testing an area, but not a full position. And I want to be able to get to 2/3 of a position if the market's holding, or a full position based upon the action. So I always want to give myself a little bit of leeway. This goes back to my point. If you're trading 10 micros, you don't want to be clicking in 1 up to 10, right? If you're getting up to 9, let's just say, I personally believe that you should do 3, 3, 3, because once again, you don't want to overtrade these products. I think it's a big mistake that a lot of people make when they get into start to trading futures, even with the bigger products, is that they'll just churning too much. They're trading too much. And so keep that in mind today when we go in and we look at the charts. All right, let's take a look at the charts. We're going to start off with a 60-minute chart. And for me, why I start off here, not a daily, is because once again, I'm taking this from the very beginner's perspective. What I'm looking for is really just a trading week here, regular trading hour session only. And once again, I'm not looking at anything overnight. This is RTH, just a 60-minute bar chart. All I have on this chart is the order flow VWAP. And that is pegged to the opening bar of every session. Monday, Tuesday, Wednesday, Thursday, right? And so you're going to have 4 order flow VWAPs on there. Now, the reason why I do this, and I think it's a very good beginning strategy, and I only looking at regular trading hours, is because I also think you should be focusing, especially as a newer trader, or even a trader who's been doing this for a while. The regular trading hours is where there's more volume. There's, I think, cleaner moves because you have the cash market open. Overnight, you just have too many different variables. And I think that the market can get jerked around a lot easier versus during the day where you have all full participation of stocks trading in there. And so especially when you're looking at the S&P 500, I always have been a believer that you want to have the cash markets open to get a perspective of what's happening. So you start off with looking at these order flow VWAPs. And what I do is, as the week goes by, I look to see where they are. And I use those order flow VWAPs as key levels of support or resistance. So what I did was I drew a horizontal line here from Monday's VWAP. Comes in right around 43.15-ish, right? You got Tuesday's VWAP comes in right around 42.73. And then you have yesterday's VWAP, which comes in right around 42.77. And so what I'm looking at here is nothing fancy. I'm taking the volume weighted average price from a session, regular trading hours where majority of the volume was traded, and I'm using those levels as support or resistance throughout the week. So a lot of you may come in and say, well, how do I know what is a support or resistance area, thinking outside the box versus just looking at what a high or a low is? Because anybody can do that. This is a very good way to see how a market would test a prior volume weighted average price as support or resistance. And I use these regularly. I really, really look at these a lot. And as you can see today, what's happening is, what I thought was very interesting as we were sitting here waiting to come online, is you look at the prior 2 days VWAPs. The market's trying to build higher, right? And I actually talked about this in my morning note today. And I talked about how I think that the bears they're trying to see if that low is really good or not. And so they're going to keep testing the market with volatility. And the bulls are kind of saying that low is kind of maybe pretty good that we had the other day. And as shorts start to sell off into the market and into some potentially some support, we'll see how we rip off of that. But if it starts to push through support, the bulls start to think, well, you know what? Maybe I am giving this up right now, and maybe this low isn't so good, and maybe we start heading lower. And so these VWAPs are really good areas because they're going to show the volume weighted average prices. The market's trying to test a low or a high, right? And so if you build off of a low or you build off of a high, volume weighted average prices are really good because if you're building on it, they're going to sustain above or below them. And so it's really easy to look at this in a 16-minute chart and say, well, look at, just as you would look at a moving average, we're below the prior 2 sessions volume weighted average price, right? From where the markets closed out that day. And that's super interesting to me because what's happening is that on a day like today, we're coming off of a recent high and we're pushing below those VWAPs. And so that is showing us negativity, right? That is showing us that the market has more sellers than buyers. The strength is in the sellers. So that's the first simple concept that I have. Now we'll go and we'll take a look at the 3-minute chart. And what I'll look at on the 3-minute chart is every day I put on the session, regular trading hours only, once again, I put this up there to where people, I'm explaining to you guys, where I can see where that order flow VWAP is, and then I add the standard deviation lines. And this is what I'm going to use as my guide to help me today, right? The standard deviation lines. So when you get a day like today where you look at the market and you say, okay, the market is opened up and it started going straight down, right? I didn't really want to look at much of a short until we got below, potentially below those VWAPs. We've now gotten below those VWAPs. And when you look at the market, you see today, I put these 2 horizontal lines. That's the opening 3-minute range. I've done a million videos on these. And really all it is I take the first 3 minutes, I mark out the high, I mark out the low. And once again, I anchor a regular trading hours VWAP right to it. You can see the colors here. If we're below it, it's red. If we're above it, the market's green. And when the VWAP gets below that opening range, I talked about this the other day, it's that opening 3 minutes is like a boxing match. You think about it as a round 1 is 3 minutes. If we violate that to the downside, well, it tells us that sellers are in control. So you have that going for the sellers today. And now we're below these VWAPs. So now you're going to look at the standard deviation lines. And you're going to look at them and say, how powerful is this move? I love standard deviation lines a lot. I think especially for newer traders is because it keeps you in the now. It's not just a static level. So you look at it and you could say to yourself, okay, right now, a second standard deviation, 64. If we start to show more bearishness and we get below 64, we have the potential to go to 55. So it's keeping you in the now of what's happening right now. And so I can trade around these areas with small risk. And we say small risk, I think in terms of price, dollar amount can be as much as you can afford to risk, but I can keep relatively tight stops if I think the market is going to expand in the range. And anytime I see standard deviation lines opening out and going outward, it's telling us that the potential is increasing. And so when you see standard deviation lines, when they're flat, then you kind of look at it and say, we're kind of boxed in, very similar to what I've talked about with Bollinger Bands. When you see standard deviation lines that are spraying one way or the other, like today, they're going straight downward. I really like that is bounce up retests if I'm bearish to sell on a second standard deviation line. So let's go to what we have here. So actually what we have here, everyone knows, I think at this point, Ninja bought Tradeovate, right? And so I use Tradeovate on the dome. I like to use Ninja for the charting. Once again, it's just a preference. I personally have gotten used to this dome. I've been using it for a while. Here's what we have. So 72.5 is an area that we're going to look for. It's 2 standard deviation away from the Bollinger, or it's 1 standard deviation away from the Bollinger Band. And the way I'm going to look at this is this. If I want to participate short, I remember I'm going to use the rule of 3. 72.5 is the first area. What I'm going to look for is I'm going to look to sell 1 just in front of that area. Okay, now what is my stop going to be? Now I'm looking for my target's going to be back down to the second standard deviation band, which is around 63, 64 area. So if you look at it, you got 72 to 64, we'll call it. So it's 8 points. So what I'm going to do is I'm going to look to say, okay, I see that the VWAP is 81. If I'm going to get one equal risk to reward, I could probably sell them up to 73, 74 if the market were to rally up in there, and I could put a stop just above the VWAP, right? And so if the VWAP comes in at 81, I'm going to look to probably put my stop initially right around 82, okay? And so I put that stop in there. So if something were to blow out and happen, immediately it would get me out, right? And so what I'm going to look to do in this specific instance is if the market gets up here, I'm going to look to sell my first one at 72. Now the market's very volatile. So I'm going to look to actually scale in up closer to my stop, right? And so I'm going to try to get my 3 contracts averaged to where I'm actually going to get my risk reward a little bit in my benefit and a little bit into my favor. And what I mean by that is if the VWAP is at 81 right now, I got to stop in at 82. I'm selling 72, so I've got 10 points of risk. But if I could average them, let's just say I'll work one at 76 and work one at 74, I'll have an average of 74 with a stop at 82, which would put me at 8 points of risk with a 10-point profit potential. So does that make sense to everybody? So that's why I bracketed out in 3, because look, if it goes up to 72 and I get filled and they starts holding, what I'm probably going to do is get in all 3, and I won't put my stop all the way up to 82. I'll move my stop lower because they rejected the 72 area right away. So it's very important to see how the action is. So what I'm going to do is I'm going to cancel these. I'm going to bring Tom back in. We've got to wait. Remember, don't overtrade this stuff. We want to be bearish. We want to be short. Work my first scale right around that first standard deviation line. And we wait and see.
So Anthony, I think that's a great explanation, anatomy of a trade. Question for you about the previous VWAP, because I see it there on the chart, that green line, kind of between where your entry is and your stop is. Do you ever use that as a way to get into a trade, or use it as a stop to get out of a trade? Or is it more informative of the bias of the day for you?
I like to have the short term confirm. It actually supersedes the longer term, right? So the longer term is, if we look at this for the week, these VWAPs went out around here, right? And to me, the shorter term actually is going to supersede that thought. And so because today we are violating it, and like I said, you've got 73 to 77. What's very interesting about that, and it also comes into my thinking, is if we get up here, we've got this VWAP, which is now 71.75. So I'll cancel that. I'll move it down to 71.25. And it tells me that that area should act as resistance on the way back. So my stop will still be above that and the VWAP's above it, right? And so the market, let's see if it can pull back up into resistance, and that's what we look to take. So it's a good point, but if I don't have the standard deviation line, this is why I like the standard deviation line so much for the newer traders, is because it's a guide. It's a guide, right? VWAP's at 80.5, 71.75 is one standard deviation below it. If the trend is going to stay really weak, you're going to get a test of that. Even in the weakest trends, you'll come back to the one standard deviation line, right? They'll bounce around there. You just got to wait for it, right? I mean, you hope at that time it doesn't blow all the way back up to the VWAP. But, on a trend day, a lot of times you'll keep retesting the VWAP and then one standard deviation, hugging the bottom 2 standard deviation, and eventually you get a blowout to the 3 standard deviation. So it's those areas are hard to trade off of, I think, for newer traders, because once again, it's more of a static level. So it's like, oh, it gets above it by 2 ticks. Am I out? Is it $2? Where do I put my stop? This helps me trail it and be with the trend.
Yeah, and I think that's important, that comment of trailing, right? It's an adaptive study. You could hang out here at 42.68 for the next half hour, but that could pull the VWAP down because it is volume trading lower than the average price, and it's adaptive. You could hit that one standard deviation band and get in a trade, or if that's what you're using as your guide, and hopefully the market continues its path down after a little bit of consolidation.
Exactly. And when you look at this also, I didn't mention this yet, and I was going to mention this when we get near the price, but that's the cumulative delta for the day. And so right now it's negative 7,200 for the day. And what I look for in this specific instance is when it gets up to the area of resistance that I'm looking to get short, what's happening with the delta? Funny enough, I've talked about this a little bit. I actually want to see the delta get bought into that area. I want to see the delta. Right now it's negative 7,200. Let's say we spike up to negative, or we spike up to 72, and the delta goes from negative 7,200 to negative 5,000. Well, that means that they net bought 2,200 on the offer. What I like about that is that they bought a bunch of contracts into this area. Now, is the market, let's watch the resistance. Let's see, does it work? If it buys into that area and blows through it right away with buying, well, then I'm probably toast and I'm just going to turn and burn out of it. But if it bids up to that and stops, that's what you want to see. And the reason why is because you want to see the pukes into your area. And when I say the pukes, is like you got a lot of people probably sitting short trying to sell into lows. They blast out of them. They get up to 71, 72 area. It's one standard deviation. Those that have been waiting to get short now have an opportunity to get in. Those that have been sitting short squeezed out. And that's what you want.
Right. Those buyers become sellers. And if it doesn't go the way they want, they're going to panic, or they're going to say, you know what, I'm out. And that just increases the pressure downward.
Yeah. I mean, every one of us knows that, like, oh, all of a sudden I'm going to go, hey, I want to be short here right now because I think we're going to go back down to 62. And it goes 67 bid, 8 bid, 9 bid. And you're like, oh my God, you buy them. And that's when the volume surge comes in, and then it breaks.
Yeah.
I mean, don't tell me it hasn't happened to any of you guys out there, because we all know it does, right? And so I've been on the opposite end of that more times than I could count. So that's why I like to look for that. And so, like I said, for this strategy, I go back to where we started today. For a micro strategy for new traders, if you want to be active, it's a simple way to come in and trade. And like I said, for me, I look at this. I'm looking at this all day. I mean, I'm going to add a few other things to my stuff, but I don't want to complicate that for this. I think for pure micros, you look at this and and also I think when you look at the micros too, you don't want to be playing for ticks, right? You don't want to be coming in here selling 72s to buy 70s or 71s. It's a bad strategy. You are going to get churned and burned out of this place. This market will just chew you up. And so you have to really look at it and go, if you're going to be trading a smaller contract, obviously because of financial reasons, or you're new, or whatever the reasons may be that I discussed, you don't want to just squeeze yourself too tight either, right? And so you don't want to be coming in here and just flipping micros for $2. That is a bad idea, okay? So what you want to do is you want to have a strategy that gives you the ability to actually come in, see that you've got a little bit of distance with your stop, right? You've got a little bit of profit potential, right? And I might not take the full profit potential, but I know that in my mind, I'm looking to get 8 to 10 points out of these moves, because and I should also say, That is not me deciding coming into the day to make 8 to 10 points. What's happening is the volatility from these lines is telling me one standard deviation moves around a VWAP are around 8 to 10 points. So I'm not deciding that. Some days it might be 5 or 6, and that's what it is. Some days I've seen it to 20 points. But this is why I like this strategy once again, because it keeps me in the now. And like right now, there's nothing I could do. And I will say this too, because I'm sure I'm going to get this question maybe later, or who knows if somebody's putting it out there right now. Do I want to sell into the 2 standard deviation for the 3? No. Why? You now put yourself in the lowest probability situation. How often do you have a 3 standard deviation move away from a VWAP? Not often. And most of the time it's on the opens or the closes, because that's when a lot of people have to trade. And so the market just gets really whippy, right? You're not going to really get that in the middle of a trading day. You have to wait for those areas to get up there, right? And that's what you want, the squeezes to occur. Those are your entries.
Right. I agree with that, sentiment about 3rd standard deviation moves, events, right? News events, which for new traders, I would not recommend trading around a news event that could move the market 3 standard deviations, because there's something that most likely you don't know, you can't anticipate, and we don't know how the market's going to react anyway. So going for that 3rd standard deviation band, very difficult.
Yeah, I mean, and the other question I'm sure people are probably thinking, well, Anthony, can I buy off the standard 2 standard deviation band? And I go back to this. Of course you can, right? It's all about the risk, what makes sense in the context of the day. In this particular day, I've talked about this. Like if we were trading above 73 to 77, and I were to see this standard deviation band sitting just above that area that I looked at for my homework, I'd buy the 2nd standard deviation band. But right now we're below it, right? And we could be potentially a trend down day. Who knows? I mean, we already are essentially, right? I mean, unless the day totally reverses. But what is the likelihood of catching the bounce at the right time? It's just too hard. Why do it? I don't want to do it. It's already proved to me through that little bit of homework that I've talked about, the market just doesn't want to hold there. So, don't neglect what the market's telling you. The market's telling you something. That's why you do your homework, right? And I'm not here to just force trades either, right? And it all comes back to everything I said with these micros. It's easy to overtrade them. You should be, I think, as I've said, using 3 different entries so it keeps you from overtrading them. You widen your horizon a little bit, even though you're a day trader. You can use standard deviation lines or whatever it is that you want to use, and you give yourself a little bit of room, and you're not just sitting there clicking all day.
Yeah, for sure. And I do really like those standard deviation bands for the fact they're adaptive, like you said. We get caught up in levels that might come from daily charts or from intraday charts. But these VWAP bands, because they're adaptive, like you said, it's the market telling you where there's interest and where the market could go. So I really like those. I agree.
I know we're burning out of time here, and I know we haven't asked DYE, and I also want to talk about something that I'm doing with CME, which is really cool. But look at how they're burning off some of this negative delta, and you could see how the market, remember we said it was negative 7,200, and now it's only 6,900, but yet the market's down ticking. That goes to show you that when buying is coming into the market and the market can't go higher. So if you had resistance here, that's what you want to see. You see the market's trying to get bought up, right? The delta's coming off the negative side to the buy side. So buyers are stepping in and the market's going, it's taking it.
Yeah, and you can see that on the current bar, right? I mean, we're trading right at the low.
Exactly. I mean, that's my point. And so that's exactly what you want to look for. I'd love to see it get taken down more, get up to the 1 standard deviation, not be able to penetrate it by much, and then bing, it comes right off. That's what you look for. So we're going to do more of these, Tom. I know it's always going to be difficult to come in and just do, a live trading session in 30 minutes. And hopefully I pick a point that I like, because I won't force trades. I won't do it for anybody, but I think I agree. Everybody got the gist of it.
Anybody can, throw in a market order, right? This is more about developing a strategy or showing what your strategy is. I agree. You mentioned Ask DYE. Ask DYE is you, the viewers, your way to ask Anthony a question about, becoming a better trader. And so we do have a question from Twitter, or X as it's called now. You can go to X and post a tweet, or post, what is it, a post now, I guess they're calling it. And just make sure you have the hashtag AskDYE, that's AskDYE, and just make sure you put in @NinjaTrader as well. And that way, if you're in the United States, we can send you something nice for contributing. But today we have from Crypto Adam, he asks, what does it mean if MACD doesn't support the current move or direction? But I think it's also, there's a second part of that is, what if MACD is going one way on one tick chart and cumulative delta is going the other way on a faster tick chart? That's two-part question, but I think they're related.
I would always look at, anytime I'm looking at like a MACD or a momentum indicator, the one thing that I always look at is divergence, right? Is the market making a lower low or a higher high or not, right? And so is the MACD going lower with a lower low, or is the MACD going lower with a higher low, right? And so I'll watch that. Anytime I see the MACD doing the opposite of what cumulative delta is, what you have to do is you really got to develop a playbook and look to see what happened after that. And as you continue to look at that over time, you put that context and nuance into that strategy, right? It's not something I really watch. I'm not really looking at the MACD. And so to say that I've seen MACDs versus, opposites of delta, but it's just the bottom line is that it's a momentum indicator. So you have to look to see, what happens after that and build that playbook up. And that's why I like divergence. What I like for a MACD, and if I were to look at any sort of momentum indicator like an RSI as well, is that I like to see the MACD potentially have divergence from the market, or even if it has divergence from what he was talking about looking at delta, like that to me is a lot of times where you're going to have a snapback potential, right? And because what's happening is at that moment, the market just, the market's just getting squeezed is really most likely the scenario. And so you're probably looking at some sort of V-type move, whether it's a bottom or a top. And so that's something that I do look at. I would look at.
Awesome. Thanks. Yeah, I have thoughts about that as well, but I think you have some businesses, you want to finish up with.
Yeah, I'm actually going to be doing some videos for CME Group for a equities challenge. It's coming up the last week of October. There will be a link in my YouTube description. Also, I'll be putting a link out on Twitter. You can go to cmegroup.com and look for it. You just search the CME Group Equities Challenge. It's going to be a lot of fun. There's going to be a ton of people in there competing. There's going to be, they're giving away cash prizes. Like I said, I love that they're doing this. I love that I'm going to be the one doing the videos for the equities. So come in there and join me. It's going to be a great time.
Yeah, I've already signed up, Anthony. And
did you?
This is a great way. This challenge could be a great way for you, the viewer, to take what Anthony is talking about in these develop your edge shows and actually apply them in a contest situation, but you're not using real money, right? It's a simulated account, and you can use his ideas to see if it works for you in this. But you're being measured against other traders. So interesting, unique way to do it. And I love these contests. I've been participating, Anthony. They're great fun.
Yeah, they are. So hopefully you guys can find the time to come in and register and sign up for it. I think it's going to be, I think there's going to be a lot of participants in it.
Well, thanks, Anthony. Thanks. Great to see you back again. It's been a while, and look forward to next week when we can do this again. Anything else? How people can find you?
Yeah, just go to Twitter or X, whatever. I don't think I'm ever going to stop calling it Twitter. Honestly, I don't know that I'm trained to call it X. I know. It's been 15 years, right? That we've been calling it Twitter. Yeah, just go to Anthony Crudele on Twitter, anthonycrudele.com. I'm also hosting contests at placeyourtrades.com for event contracts. And I think that would really be something, if you're interested at all in trading really is the real zero DTE. We're giving away cash prizes as well at placeyourtrades.com /contest or challenge. Maybe I'm getting that wrong right now. The team's going to be pissed at me, but go to placeyourtrades.com to learn more about that.
Awesome. Thanks for that, Anthony. Thanks to you, the viewer, for joining us for this Develop Your Edge show. We'll be back next week. In the meantime, have a great trading day.
See ya.